Welcome to the Retirement Wealth Podcast. We're so glad you're here with us today. You know, navigating retirement can be a bit tricky, especially when it comes to taxes. Have you ever heard of tax loss harvesting? It's a strategy that can really help you make the most of your investments in retirement.
Absolutely, Emily. Tax loss harvesting is one of those concepts that can sound a bit complex at first, but it can be a game changer. It's all about offsetting gains with losses to reduce your taxable income, and that can have a big impact on your retirement savings.
Right. So we'll dive into what tax loss harvesting is, how it works, and most importantly, how you can implement it in your own retirement strategy. We'll also touch on some common pitfalls to avoid and the benefits it can bring.
And let's not forget, we'll discuss the timing of when to implement this strategy, plus how it fits into your overall financial plan. It's all about ensuring that your retirement is as financially secure as possible.
Exactly. So whether you're getting close to retirement or you're already enjoying it, understanding these strategies can really help you keep more of your hard-earned money in your pocket.
Definitely. Let's jump right in and start breaking down tax loss harvesting, what it is, and how it works. You know, Emily, with everything that's been going on in the economy lately, it really brings the importance of tax loss harvesting into sharp focus. People are feeling the pinch from inflation, and volatility in the markets isn't helping either.
Absolutely, David. I think many folks are feeling uncertain about their retirement timelines. They might be wondering if they can still retire when they planned, or if they need to push it back a few years.
Right, and that's a valid concern. Take someone like Tom, for example. He was planning to retire in the next couple of years, but with the market taking some dips, he's been second-guessing that timeline. Tax loss harvesting could be a way for him to offset some of those losses, and maybe even provide a little cushion during these turbulent times.
Yeah, and it's not just about the timeline, right? With inflation eating away at purchasing power, retirees need to think about how to stretch their dollars further. Tax loss harvesting can help enhance tax efficiency, which is crucial for maintaining that purchasing power.
Exactly. When you can offset capital gains with losses, that's money that can stay in your pocket, and it can make a real difference over time. I've seen retirees like Susan, who, after selling a property, found herself with a sizable capital gain. By using tax loss harvesting, she was able to offset that gain and save a significant amount on taxes. It helped her keep more for her travel plans in retirement.
That's a great example. And with the rising healthcare costs, which seem to be a constant concern for many, having those extra funds can really ease the stress. It's like a safety net, you know?
Absolutely. Healthcare can be one of the biggest expenses in retirement. If someone is facing unexpected medical bills, having a tax-efficient strategy can alleviate some of that financial burden. And then there's Social Security changes to consider. With adjustments happening regularly, it's vital to have a flexible approach to your retirement planning.
And that's something I think a lot of people overlook. They might think Social Security will cover their expenses, but it often doesn't, especially with rising costs. So having additional strategies in place, like tax loss harvesting, can help bridge that gap.
You're spot on. Plus, with the way the economy is evolving, many retirees are looking to leave a legacy. They might want to pass on their wealth to their children or grandchildren. By being strategic about taxes now, they can ensure more of their hard-earned savings get passed down.
That's so important. I remember chatting with a couple, Mike and Linda, who were really focused on legacy planning. They realized that by utilizing tax loss harvesting, they could significantly reduce their tax burden while still providing for their family. It made them feel more secure about their financial future.
Yes, that emotional side of financial security is huge. It's not just about the numbers. It's also about peace of mind. When retirees feel confident in their financial strategies, they can enjoy their retirement more fully. They can focus on the things that truly matter, like spending time with family or traveling.
Right, and it's all interconnected. The stress of market volatility and inflation can really take a toll on mental well-being. Knowing there are strategies, like tax loss harvesting, available to help manage those stressors can be incredibly reassuring.
Exactly, and many people don't realize that tax loss harvesting isn't just for those who are actively trading stocks. It can be applicable for retirees who might have investments in their portfolios that have dipped in value. It's an ongoing strategy that can be revisited regularly.
That's a really good point. It's like having a financial toolkit. You can pull out different tools based on what's happening in the market or your personal situation.
Right. And we're in a time where being proactive is more essential than ever. The current economic trends are showing that things can change quickly. So having a strategy that allows for adjustments, like tax loss harvesting, can really help manage those ups and downs.
And it's not just a one-time thing, right? It's about being engaged and aware of your investments and continually looking for opportunities to optimize your tax situation.
Exactly. It's about staying informed and making those strategic decisions as circumstances evolve. For instance, if you have a downturn in one part of your portfolio, you can sell those assets at a loss and use those losses to offset gains elsewhere.
That's such a smart move. And it's about making sure your overall financial picture remains as strong as possible, even when parts of it are facing challenges.
Yes, and it's important to remember that tax laws can change, so working with a financial advisor who understands these nuances can really help navigate through any complexities.
That's a great takeaway. Having someone in your corner can really make a difference, especially during times of uncertainty. It allows you to focus on what matters most to you in retirement.
And that's the goal, isn't it? To enjoy retirement without the constant worry about finances. By implementing strategies like tax loss harvesting, you're not just reacting to the market. You're taking control of your financial future.
Exactly. So let's dive into some core strategies that people can use to start implementing tax loss harvesting effectively in their retirement plans.
So, Emily, one of the key strategies we're talking about is tax loss harvesting. It's essentially a way to offset gains by selling investments that have lost value, right?
Exactly. And, it's especially useful in retirement when you're drawing down your portfolio. When you sell a losing investment, you can use that loss to offset capital gains you might have from selling other investments at a profit.
Right. So let's say you have a stock that you purchased for $10,000, but it's currently worth $7,000. If you sell it, you realize a $3,000 loss. If you also sold another stock for a $5,000 gain, that loss can offset that gain completely.
That's a perfect example. It means you only pay taxes on the net gain, which in this case would be $2,000 instead of $5,000.
Exactly. And it can be a powerful tool to minimize your tax liability. One rule of thumb is to consider doing this towards the end of the year, when you have a clearer picture of your overall capital gains and losses.
Yes, and you can even use losses to offset ordinary income up to $3,000 per year. If your losses exceed that, you can carry them over into future years.
That's a great point. It's like having a little cushion for your tax bill. But, it's important to keep in mind the wash sale rule, right?
Right, that rule says if you sell a stock at a loss and then buy the same stock back within 30 days, you can't claim that loss for tax purposes. So you have to be careful about how you reinvest that money.
Yes, you might want to look for a similar investment or a different stock in the same sector. It keeps your portfolio diversified, while still allowing you to take advantage of that tax loss.
Speaking of diversification, that's another fundamental strategy in retirement planning, isn't it?
Absolutely. A good rule of thumb is to maintain a balanced portfolio, like a 70-30 split between stocks and bonds, depending on your risk tolerance and time horizon.
Right. So if you're 65 and planning to retire soon, you might lean more towards bonds, which are generally less volatile than stocks.
But you don't want to go too conservative either, because you still need growth to outpace inflation. A common approach is to gradually shift your asset allocation as you age.
That makes sense. And when we talk about withdrawal strategies like the 4% rule, it's essential to align that with your asset allocation too.
Exactly. The 4% rule suggests that you can withdraw 4% of your retirement savings each year, adjusted for inflation, and have a reasonable chance of your money lasting for 30 years.
But if most of your investments are in bonds, and they're not growing as quickly, you might find yourself needing to adjust that withdrawal percentage.
Right. That's where the bucket strategy can come in handy. You set up different buckets for different time horizons, Short-term needs in cash or short-term bonds, and longer-term needs in stocks.
So you would have a bucket for the first few years of retirement, maybe a second bucket for the next 5 to 10 years, and then a growth bucket for the long term?
Precisely. It helps you manage your cash flow while keeping your long-term growth potential intact. And remember, with tax-advantaged accounts like IRAs and 401ks, you can strategize withdrawals to minimize tax impacts.
You can withdraw from your taxable accounts first to allow your tax-advantaged accounts to grow, right?
Exactly. And don't forget about Social Security optimization. Timing your benefits can significantly impact your overall retirement income.
Yes. If you delay taking Social Security, you can receive a higher monthly benefit later on. Sometimes people don't realize the difference it can make.
It can be substantial. Each year you delay past your full retirement age increases your benefit by about 8% until age 70.
Wow. So if you can afford to wait, it really pays off. And when you combine that with good withdrawal strategies and tax planning, you're setting yourself up for a more comfortable retirement.
Definitely. But it's also crucial to think about tax implications when you're withdrawing from your accounts.
Right, because taking money out of a traditional IRA or 401k is going to be taxed as ordinary income, while withdrawals from a Roth IRA are tax-free.
Exactly. And that can affect your tax bracket. Planning your withdrawals carefully can help minimize taxes over time.
And it's worth mentioning required minimum distributions, or RMDs, too. Once you hit age 72, you have to start taking those distributions from your tax-deferred accounts.
Yes, and those can push you into a higher tax bracket if you're not careful. It's essential to plan for those RMDs to avoid any surprises.
So what we've talked about today really shows how interconnected all these strategies are, doesn't it?
Absolutely. It's like a puzzle. You have to fit all the pieces together for a comprehensive retirement plan.
But with all these strategies, there are some common pitfalls people need to be aware of, too.
For sure. Let's dive into those next. You know, Emily, one of the biggest pitfalls I see in retirement planning is the sequence of returns risk.
Yeah, that's a big one. It's like, if you hit a market downturn right when you start withdrawing from your portfolio.
Exactly. It can really derail someone's retirement plan. I worked with a couple, let's call them Tom and Linda. They retired in 2008, right before that huge market crash.
Oof, that's rough. What happened to them?
Well, they had a solid plan, but they didn't consider that their withdrawals would coincide with market declines. They were taking out a set percentage annually, and when the market tanked, their portfolio value dropped significantly.
So they were forced to sell investments at a loss just to cover their living expenses.
Right, and that's the danger. It can lead to a death spiral in the portfolio if they can't recover from those early losses.
That's pretty scary. What could they have done differently?
A more conservative withdrawal strategy could have helped. Maybe they could have kept a cash reserve to ride out the downturn, or adjusted their asset allocation to be less aggressive as they transitioned into retirement.
That makes sense. And I guess that ties into not ignoring taxes when making withdrawals, right?
Absolutely. I see a lot of retirees overlook the tax implications of their withdrawals. For instance, there was a gentleman, let's call him Jim, who was withdrawing from his traditional IRAs without considering the tax hit he'd take.
Did he end up in a higher tax bracket?
Yes, exactly. He ended up paying way more in taxes than he anticipated, which meant less money for him to spend.
Wow, that's frustrating. So what's a good strategy for managing withdrawals in retirement to minimize taxes?
Well, a mix of accounts is crucial, like having both tax-deferred and tax-free accounts. It allows retirees to strategically decide which accounts to draw from to manage their tax liability effectively.
So, like using Roth IRA withdrawals in a year when their income is higher, and traditional IRAs when it's lower.
Right. It's all about being strategic and flexible with withdrawals, and understanding how it all fits together.
And then there's the issue of healthcare and longevity, right?
Definitely. Many retirees underestimate their healthcare costs. I had a client, Sarah, who thought she'd be fine with her Medicare coverage, but she didn't account for the out-of-pocket expenses.
That's a common misconception. What happened with Sarah?
She ended up facing a significant amount of unexpected medical bills, and because she hadn't planned for that, it strained her finances in retirement.
So what should people do to prepare for those kinds of expenses?
It's important to have a realistic estimate of healthcare costs. I always recommend looking into supplemental insurance or considering a health savings account before retirement.
That's great advice. And then there's the whole longevity issue.
Right? People are living longer than ever, and that can really affect how long your savings last. I had another client, Dave, who planned for a 20-year retirement but didn't account for living to 90.
Yikes! That's a significant difference.
It is. He had to make drastic cuts to his lifestyle later on because he wasn't prepared for that extended period.
So planning for a longer time frame is crucial. What are some ways folks can prepare for longevity?
Diversifying income sources is key. Having a mix of Social Security, pensions, and investments can help, and also considering long-term care insurance can be a smart move.
Speaking of Social Security, I know claiming it too early can be another mistake.
Definitely. I've seen many clients who claimed at 62 without understanding the long-term implications. For instance, a couple, Mike and Karen, took it early because they thought they needed the income.
Did they regret that decision later?
Yes! Later on, they realized that their monthly benefits would have been significantly higher if they'd waited. It's about weighing the immediate need against long-term benefits.
So it's really about understanding the value of waiting, right?
Exactly. The longer you wait to claim, the higher your monthly benefit will be. It's a tough decision, but it can pay off in the long run.
And that leads to the asset allocation issue, too.
Yes, many retirees don't reassess their asset allocation as they age. I had a client, Laura, who was still heavily invested in stocks even in her late 70s.
That sounds risky.
It is. When the market took a downturn, her portfolio took a hit, and she didn't have enough bonds or safer investments to buffer that risk.
So what's the solution there?
Regularly reviewing and adjusting your asset allocation as you age is critical. It's about balancing growth with preservation of capital.
And all of these mistakes, like sequence of returns risk, ignoring taxes, and underestimating healthcare, can signal red flags early on, right?
Absolutely. If someone is relying too heavily on one income source or has a lack of diversification, those are red flags.
And it sounds like the key is to be proactive.
Yes, being proactive and planning for the long term. Regularly reviewing your financial plan can help spot those issues before they become bigger problems.
So if someone finds themselves in these situations, what are some next steps they can take?
First, I recommend working with the financial advisor to reassess their retirement plan, focusing on those key areas: withdrawals, asset allocation, and healthcare costs.
And it's never too late to make adjustments, right?
Exactly. Even small changes can have a big impact over time. It's about taking control and making informed decisions.
That's such a positive note to end on. Taking control of your retirement planning can really lead to a more secure and fulfilling retirement.
All right, so let's dive into some immediate steps folks can take right now to implement tax loss harvesting in their retirement planning.
Yeah, that sounds great. What's the first thing they can do?
Well, the first step is to really take a closer look at your investment portfolio. Reviewing it at least quarterly can help you spot any potential losses that you could harvest.
Right. And it's important to keep an eye on those investments, especially with the market fluctuations we've seen recently.
Exactly. And if you haven't already, consider using some of the retirement calculators available through platforms like Vanguard, Fidelity, or Schwab. They can help you run projections and see how tax loss harvesting might fit into your overall strategy.
Those tools are super helpful. Are there specific calculators that focus more on tax impacts?
Yes, definitely. For instance, Vanguard has a great tool that allows you to input your current investments and see potential tax implications. It's user-friendly, and you can get a clearer picture of where you stand.
That's fantastic. And, many people might not realize they can access their Social Security statements online too, right?
Yes, SSA.gov is a really important resource. It's not just for Social Security benefits, but also gives insights into your overall financial picture, which is so useful when planning for retirement.
And speaking of resources, what about tax software or financial planning apps?
Absolutely. Using tax software like TurboTax or H&R Block can help you track your gains and losses throughout the year. Plus, there are some great financial planning apps like Personal Capital or Mint that can help you manage your investments and see how tax loss harvesting could impact your financial situation.
Those apps can make tracking so much easier. It's all about finding what works best for you, right?
Exactly. And starting small with consistent habits can make a big difference. For instance, running those retirement projections regularly can help you stay on track.
Right. It's like having a financial checkup. What other habits should people get into?
Well, it's helpful to set aside some time each month to review your portfolio and make adjustments as needed. Just being proactive can really pay off in the long run.
And it's never too late to improve your plan, right?
Exactly. No matter where you are in your retirement journey, taking these small steps can lead to significant improvements over time.
What about books or podcasts that might help our listeners dive deeper into retirement planning?
Oh, there are some fantastic resources out there. For books, the Boglehead's Guide to Retirement Planning is a classic. And if you're looking for podcasts, the Retirement Answer Man is pretty solid, offering practical advice and tips.
Those sound like great recommendations. I love that there's so much information available now.
Absolutely. And it's all about finding the right resources that resonate with you. And remember, you don't have to do it all at once.
Yeah, just take it step by step.
Right, and if you focus on one aspect at a time, you'll find it easier to manage.
So those are some practical first steps. Now let's bring this all together.
Well, Emily, as we wrap up this episode, I think we've covered some pretty essential points about tax loss harvesting.
Absolutely. One of the biggest takeaways is that tax loss harvesting can help retirees offset capital gains, which can really lighten the tax burden.
Right, and it's not just about saving money on taxes, but also about managing your investment portfolio more effectively.
Exactly. We also talked about how it's important to stay aware of the wash sale rule. It's a little tricky, but knowing the ins and outs can save you from some major headaches.
And let's not forget the value of working with a financial advisor who understands these strategies. It can make a huge difference, especially if you're navigating retirement planning.
Yes, having that guidance can really help you make informed decisions. Plus, it's always nice to have someone in your corner, right?
Definitely. And remember, the goal is to build and protect your retirement wealth, so utilizing strategies like tax loss harvesting can be a smart move.
Well said, David. And for our listeners, we'd love to hear from you. If you found something valuable in this episode, please like, subscribe, and share your biggest takeaway or any questions you might have in the comments.
And if you know someone who's planning for retirement or already in it, sharing this episode could really help them too.
Yes, we all want to retire well, and sharing knowledge is a great way to support each other.
Next time, we'll dive into a fascinating topic about how to turn your home into retirement income.
That's going to be really insightful. So stay tuned for that.
Thanks for joining us today.
Absolutely. Take care, everyone, and we'll catch you next time.